Hello, everybody. My name is Mark, and I am the stock market jobber. I'm a former institutional trader. I spent about 20 years in the institutional trading world. I traded directly for Stephen Cohen, who's probably the greatest trader in history. I also traded directly for Mario Gabelli, who's one of the best money managers in history. And then I was the head of trading at three different institutional money managers, which all manage in excess of $1 billion. And I oversaw a lot of different trading strategies, various hedge funds, mutual funds. I was a market maker. So now what I want to do is teach people like yourself about how the market really works and how trading really works because there's a lot of misconceptions out there. And I know you want to learn because if not, you wouldn't be listening to me. So please make sure you sign up for our YouTube page here and check out our website, stockmarketjobber.com. And let's just take a look at 7 things to have on the radar screen today that I'm looking at. So we've had a pretty nasty sell-off in the S&P. This is the S&P 500 ETF. SPY is tracks the S&P 500. It's 1/10 of the value. So if this is at 400, you know the S&P is at 4,000. So we've had a pretty nasty sell-off over the last few days, but we're kind of consolidating. And that's not surprising because markets like nice round levels. People like to buy at nice round levels. So this is what we call a psychological level, 400. Most people don't say I'll buy it if it gets to 402, or I'll buy it if it gets to 398, or I'll sell it if it gets to 406. They think, all right, well, if it gets to 400, I'll buy it or I'll sell it. So we got some support there. If we go lower, I think we're going to get some support and probably a bounce off of this line here. This is around 390. Now, one of the principles of financial markets is that there are certain price levels that are more important than others. In the institutional world, people don't look at things like Fibonacci or Elliott wave or Gann theory. We look at things like what's the important level, what's the momentum, what's the trend, and what's the psychology. Now, when you look at a chart, if you look at it the right way, you're looking at psychology. Notice how this level was support, and this level was resistance, and then it became support again, and then it became resistance again, and then it became support again, and then it became resistance again, and then it became support. This is clearly a important level. You don't need to be a big shot stock market guru to know that. Now, when a market's going lower, it's because there's not enough supply. There's not enough demand to absorb all the supply. Demand are buyers or buy orders. So the sellers are forced to offer their shares out at a discount, and that forces a downtrend. When we get to a support level, all of a sudden there is enough demand or buy orders to absorb all of the supply or sell orders. This is why sell-offs tend to stop or potentially even reverse when they reach them. So we have a lot of investors bought here. The stock rallies or the ETF rallies falls below it. Now a lot of the investors who bought here are now experiencing buyer's remorse. They tell themselves, I made a mistake. I want to get out, but I'm only going to do so if I can get out at the same at break even. So they place their sell orders at the same level they had their buy orders at. So buyer's remorse turns support into resistance. You can see this on a lot of charts. Here we have the opposite. Seller's remorse turns a resistance level into support. Investors who sold, a lot of them regret doing so when the price goes higher, and they tell themselves, I'm going to buy my shares back, but only if I can get them for the same price I sold them at. So if there are enough remorseful sellers placing buy orders, the level that was resistance can turn into support. And then we see it turn back into resistance and support. So this is an important level. If we go lower, and my suspicion is that we will, we're probably going to get a bounce off of this because it's an important level. So hanging out just around 400, consolidating after a big sell-off, but importantly not rebounding. Yesterday the Fed minutes seemed a little bit hawkish. 10-year yields are really starting to surge again. So there's a couple things out there that could cause a little concern. All right, let's take a look at the second thing I'm watching here. So Nvidia reported, and here we can see some interesting things with the charts. When we look at charts, we got to understand we're looking at an illustration of supply and demand and market psychology. Now we have a resistance level here, right? Resistance is a large group of sellers. When a market's going higher, it's because there's not enough supply or sell orders to fill all of the demand or buy orders. So the buyers are forced to pay a premium, and that forces an uptrend. When we get to resistance, well, we have enough supply that all the demand can be filled. So a lot of times we get to resistance and we go lower, right? Or it stalls out. Now, why would we sell off of a resistance level? Like we can see here. Well, what happens is some of the, and this happens on office support levels too, but it's people buying, but it's the same concept. So sellers start to get the sense that there are other sellers lurking around. That's why the price isn't going up any higher. So they start to get nervous and they start to think, oh boy, I'm at 191. I don't want to miss this. So I'm going to reduce my price to 190. So if there's a buyer, they're going to come to me because I have the lowest offer price in the market. Someone else could see, oh, he went to 190 or she went to 190. I'm going to go to 189. And it becomes this snowballing effect. So this is why when you get to resistance, you can tend to get sell-offs. And when you get to support, you tend to get rallies. Now, this is an interesting hint here too. This is what we would call a type of an ascending triangle pattern. A lot of patterns I don't really teach about because I don't think they're very valid, to be perfectly honest with you. But that's not the case with the ascending triangle. The key here is to understand that this higher low here, markets go in peaks and valleys. And when you have a valley that forms at a higher level than the last valley, it tells you that buyers are becoming more aggressive. They're willing to pay higher prices. So a lot of times when you get this ascending triangle type pattern going into resistance, it's a signal that there's a good chance the resistance is going to break. And that's what happened here. So Nvidia is up big this morning. Okay, it gapped up on earnings, but I don't think these earnings are all that good. As a matter of fact, they're really bad. So, so I wouldn't be surprised to see Nvidia give back some of these gains over the next few days. I mean, their operating income was down 58%. The revenue was only down 21%, but their operating income, which is basically the bottom line, how much money they have left after all the costs are taken into account. You have revenue, which is your total sales, and then if you take out all the costs, what you're left with is your net income or your operating income. And they're down huge. Earnings are down 52%. So these were not good numbers. I mean, people are excited about this whole AI thing, but I think there's a good chance that we reverse over the next few days. It could be similar to what happened here with Facebook, or sorry, Meta. I just call it Facebook, but whatever. Um, People thought the earnings were really good because they said they were cutting expenses. Well, when you cut expenses, that's a sign that things aren't going so well. So after a few days, we started to reverse. And I believe that we're going to continue to reverse. And I think we're probably going to get down to around here. So we have a couple interesting things going on here, too, that we can look at. We talked about the ascending triangle. This is a descending triangle. We have buyers who are just kind of chilling out, okay to hang around the 183 level, but we have higher or lower highs here. The peaks are forming at lower prices than the prior peak. This tells us that the buyers are content to stay around here, but the sellers are getting more aggressive. They're willing to take lower prices. So a lot of times when you have a descending triangle pattern getting to resistance, it's a sign it's going to break. Down here, we have the ascending triangle. And when we got up to resistance, this was a sign that this was going to break through here. I mean, it's not a guarantee, it's not perfect, but if you understand how to view these charts through the prism of supply and demand, you're going to be a lot better off. A lot of trading, other trading teachers I see on YouTube here, I mean, I don't. I put it this way: I've yet to see someone that I've been impressed with that I would actually say this person knows what they're talking about. But I mean, I think that people try hard, but maybe they just don't have the amount of experience that I do. Um, but anyway, here we see support turns into resistance. Okay, support turns into resistance. Remember, buyer's remorse. People who bought here, a lot of them regret doing so when the price goes lower, and they say, if this gets back up to my buying price, I'm going to get out at break even. So we have remorseful buyers placing sell orders at the same level they bought at. Same thing down here. Remorseful buyers placing sell orders at their buy price. Now here we can see that resistance became support for a few days. More like a week. Looks like it was 6 days. And this is our seller's remorse. People who sold here, once the price went higher, a lot of them regret doing so, and they tell themselves, I'm going to buy my shares back, but I'm only going to do it if I can get them for the same price I bought them at. So we have remorseful, or same price I sold them at. So we have remorseful sellers placing buy orders at their sell price. And that turned that into support. But like I said, after a few days, I think the market started to realize, wait a second, these numbers were not as good as people think. They missed their estimates, and I think their operating income was down about 50%. So I wouldn't be surprised to see Nvidia do something like this relatively soon. And here we have a gap. You've heard the expression gaps refill. Like down here, we gap down and we have this quick move right back up through it. This happens because, think about it, right? One of the reasons why we have support is because of seller's remorse. Remorseful sellers placing buy orders at their former selling price. If something gaps up, meaning it closed at this price on this day and it opened at this price on this day, well, there was no trading in these price levels. So if it didn't trade there, you're not going to have remorseful sellers trying to buy their shares back, because if it didn't trade there, no one could have sold there. So gaps tend to refill. And again, if you understand the supply and demand dynamics that I teach, well, not that I teach, but that the market has, well, I guess I could say I teach them, you'll understand why a gap would form. So this chart's a clear illustration, right? Some price levels are more important than others. These ascending and descending triangle patterns tend to be pretty reliable, and gaps tend to refill. So here, when we closed here and opened here, there was no trading in here, so there was no one who bought it. One of the reasons why we have resistance is because we have remorseful buyers placing sell orders. If the stock never traded in these price levels, no one could have bought it there because it didn't trade. All right, next up is Tesla. Here's an example of a psychological level, right? 200. There's been some support around $200. You can see we've broken the uptrend, meaning right now we're trading lower than any time where we've been over the past week or two. And if this support breaks, there's a good chance we get a decent move lower. And that's because if the support breaks, meaning the price trades below it, it shows us that the investors who created the support with their buy orders have left the market. Maybe they finished their orders, maybe they canceled their orders, but regardless, they're out of the way. And anytime you pull demand out of a market, it sets the stage for a price to go lower. It's just basic economics 101. So keep an eye on this 200 level. If it holds, there's a good chance we get a move higher. But if it breaks, we're getting a good chance we get a decent move lower. I don't think it's going to hang around $200 for that much longer. It's going to go one way or the other. And it is kind of trending lower here. And here we can see support becomes resistance. Let me show you something else on Tesla that's pretty cool. Momentum refers to how far a particular market moves from time period A to time period B. And most of the time, a stock or a market or a crypto or whatever it is, any kind of security, will spend the vast majority of its time trading in what would be its typical or historical trading range. If we get below that, we call that oversold or oversold momentum. If we get above it, we call it overbought momentum. All right, so when you hear overbought or oversold, that's referring to momentum. This particular indicator down here is very effective and it's very simple. It's called the relative strength index. And that 14 here means it's measuring 14 time periods. How much has the stock moved in 14 time periods? If we get above this, if this blue line gets above this red line, it indicates overbought conditions. And if it gets below it, it indicates oversold conditions. Now, right here, I'm going to circle this. Right here and right here. This here was literally the most overbought that Tesla had been in the history of its stock since I think it was 2012 it went public. And sure enough, look at that. This is like panic buying. People think they're going to miss out. and they just go out and they're willing to pay any price, and the thing gets overbought, and overbought conditions attract sellers into the market. So a lot of trading models or strategies on Wall Street are based on the concept of reversion, right? Reversion to the mean. So when something's overbought or oversold, if it's overbought, people will be expecting a sell-off, which is what happened here. Now this here is the most oversold that Tesla had ever been in its history, right? So when you see something that gets to an historical extreme, as a trader, we want to pay attention because there's a good chance it's going to set up to move. When a stock gets to support and it's oversold, it tends to rally. And sure enough, that's what happened here. Now, this is an example of what we call market memory. Some of these, oh, I'm sorry, this says 6 months. That's wrong. Sorry about that. I'm going to cross that out. And this is 3 years. Sorry about that, everybody. Oops. All right, so 3 years. So look back here. This is probably June or July of 2020, and this is September, October maybe of 2020. We can see here that resistance turned into support. Now, market memory means that a level that is important can retain its importance for a long time. Could be months, could be years. And look at this. We found support at the exact same level that we found support back here. So this was, in hindsight, this was an easy trade, right? Extremely oversold and at a support level. There's a good chance it's going to bounce, and that's what happened. Remember, support is a lot of buyers, and oversold is going to attract more buyers into the market. So what happens is the buyers start to get the sense like, oh man, there's other buyers around. That's why it's not going any lower. I better increase my price. Instead of paying 110, I'm going to pay 115. Someone else sees that and they say, I'm going to pay 120. And we get this snowball effect. And before I go, I just want you to look at this 10-year Treasury yield. This is clearly bearish for the market. Higher yields are bearish for a market because, one, it takes money off of the bottom line of companies. Companies don't take money out of the cash register to pay their daily operating expenses. They borrow money from banks in these short-term borrowing arrangements. If interest rates are going higher, the money costs more to borrow. That takes money out of the bottom line of the company. Also, if interest rates are going higher, the funds that use leverage might use less leverage because leverage is just borrowing money to help magnify your trades or your performance. In other words, say you have $10 million and you go up by $2 million, you're up 20%, right? Well, if you had leverage and you borrow $10 million, now you're controlling 20 million. If the market goes your way, if it goes up 20%, you're going to make 4 million. So that's why firms use leverage. But of course, it goes the opposite way too. They could make money faster, but they could lose money faster if they're wrong. Anyway, I think this is pretty bearish for the market. People will really start to notice if we get back above this 4 level. Look, this goes all the way back to, we're at rates now that we haven't seen in over a decade. Okay, so inflation is still out there. I don't think the Fed is going to stop raising rates anytime soon. And this could end up being bearish for the market. And could be the catalyst that drives that SPY down to 390. All right, that's it, everybody. Thank you so much. Make sure you check back tomorrow. Make sure you subscribe to our YouTube channel here. Check out stockmarketjobber.com. And I will see you soon.